Welcome, everyone. This is episode 6, bringing on-chain capital to essential housing. With me, I have Celadon Financial and Littlestone, which is a Littlestone Company, which is a development company. Collectively, we announced $1 billion housing pipeline to build essential housing, and so I'm excited to have Steve Wasserman from the Littlestone Company. He's the co-founder, chairman, and managing director. And Tom Weyl from Celadon. He's the head of Municipal Solutions at Celadon Financials. And prior to Celadon, Tom was one of the senior members at one of the largest municipal underwriters, Morgan Stanley. So, Steve, Tom, welcome to X Spaces.
Thank you, Manish.
Thank you.
And also with me, I have my colleague, Jim Tinker, who does just about everything at Alphaledger. So, Jim, welcome aboard to X Spaces as well. Before we get started, just a disclaimer for everybody. The views expressed in this space is that of the individual presenters and does not necessarily reflect the views of Alphaledger, Celadon, or the Littlestone Company. Nothing discussed in this space should be considered an investment advice. And so let's get started. Steve, I think let's start with you. One, I would love to get to know your background a little better. So I think it's important for the audience to understand that you come with a deep of housing development. How did you get started? How did Littlestone Company come about? Before we really talk about essential housing, what it is, and why increasingly it is out of reach for the people who need it the most, which are effectively the teachers, the nurses, the policemen, the firemen, and the seniors. So with that, Steve, would love to hear your background and let's get into it.
Sure. Thank you very much. Appreciate it. A long background. I'll start and make it as brief as I can. Won't start at the beginning, but way back beginning, I started as a CPA, a Price Waterhouse guy, and eventually found my way to a real estate development and management company in Chicago, and it was called the Littlestone Company. And it was a great experience for me. I knew nothing about real estate. I came in as the controller. Littlestone at that point was part of a New York Stock Exchange company, and so one thing led to another. Went through various real estate cycles, and wound up working for what is now U.S. Bank, and came to Atlanta as a bank officer and an officer of at the time of the second largest REIT in the country, and managed a portfolio of probably about, in today's dollars, $100 and some billion, and always I would say not always, but pretty much focused on multifamily housing. And so as things wound down with the bank, I started my own company in 1977. So we've been around a long time, and we've managed a number of cycles, as you all know. There have been quite a few, and mostly focused on the development of what we called in those days middle income housing. And they were not deeply skewed affordable, nor were they luxury. But we kind of made our knitting on these projects, many of which were financed with HUD financing. And so we wound up doing quite a few projects around the United States. And gradually, in about 2000, sort of morphed over to doing more deeply affordable projects and utilizing tax-exempt bond financing because it was available, and we had to operate through a not-for-profit, and that was fine with us. We're essentially fee developers. And so we put together a not-for-profit owner and had about 18 or so properties from New Mexico to Vermont and down to Florida and Texas and a bunch of places. And the purpose of that was to acquire and preserve affordable housing. And affordable in those days was everything from deeply affordable, that could be project-based Section 8 or vouchered Section 8, to some other things. So okay, so I'm sorry, I just got a message that somebody's having difficulty getting on this. So we did all that for about 25 years. Company grew, and we decided we would focus a little bit on some more conventional GP-LP type structures and move more into the workforce space. Now, Workforce is an interesting couple of words or one word, depending on how you spell it. We always, when we were doing zonings, we would often refer to workforce, and nobody knew what it was. So it was very easy to say, well, it's teachers, it's nurses, and and that was generally, and firemen and policemen, and that was generally during zoning meetings, and sometimes that got the sympathy of the NIMBYs, and sometimes it got the sympathy of the local officials, and sometimes nothing happened. But as we've moved along the timeline, workforce housing is becoming more and more of a understood term and more acute, the shortage of workforce housing. And I'll wrap this up by giving what we consider to be the definition. Workforce housing in our mind is folks, again, typically teachers, nurses, service workers, etc., often seniors who make too much, who have too much income to qualify for supportive housing, supportive being in the nature of Section 8 or things like that. And they make too little to afford market rate because, as everyone knows, the cost of housing nowadays is just off the charts. So they're stuck in the middle, and often they really are literally priced out of the housing market, both on the high end and the bottom end. And so we've decided that to a great extent, that's our focus. And again, we operate through a not-for-profit. So we leave money on the table, and we can provide a more incentivized rent structure. And so that's a little bit about us, what the product is, and I'll pass the ball back.
Yeah, no, Steve, that's super insightful. I mean, look, what I find really interesting is that the real estate market, US globally, is worth trillions and trillions of dollars. Yet we find that missing middle, which is the segment that we're talking about today, is really hard to finance. I mean, structurally, you would imagine that local communities, municipalities would really lead with this. And so I'm wondering, Tom, I mean, given your background and history in the municipal finance, why is it so hard to finance this sector? Because it is clearly an important one. I mean, we talk a lot about housing in this country. We talk a lot about the need to own home, especially as it relates to people that are employed and doing really well in their careers, whether they're policemen, whether they're firemen, whether they're teachers, senior citizens. Why is it so hard?
Well, I think the answer really on that is the financing markets really gravitate to the ends of the spectrum. And Steve mentioned several notable government programs available for the truly low income residents, say below 30 to 50% of AMI. And then also the high end of the market is very easy to finance. And it's that middle that's difficult. The supply of available housing at this level is not sufficient to meet demand. So we have high demand for housing, very little supply. And what we end up having with that is low income people crowding out other sectors of the market. So if there's not enough housing vouchers for the low income people, they're in apartments that typically would go to middle income people. The middle income people are also squeezed out. At the middle market, say 60 to 140% of AMI, there are limited to no existing housing programs targeting this market. There's no government subsidies, there's no government programs for that. So instead, as Steve mentioned, you're going to finance them many times through not-for-profits. Well, right there, you have a capital issue because not-for-profits can't raise equity. They don't typically have large balance sheets to put money into a project. And so what we have is a real estate market that demands a multi-tiered capital structure for the senior debt to be sold in the marketplace, but we have a lack of capital for that area. The tax exempt municipal bond market can be a good alternative, but we have this limitation to access because of the capital stack. That's why this team on the X Space today is working on solutions to that market access problem. And I think it would help to really define kind of what this problem is. If you think about the city of Miami, in the Miami area, that 80% of AMI in the city of Miami means basically paying $1,100 a month, actually $1,200 a month in rent. So think about the type of housing you're going to get in a big city like Miami at $1,100 a month. It's not very good. So what happens and what the problem is for the missing middle is these folks have to live far away from where they work. So you've got essential service workers, you've got teachers, you've got first responders, you've got other healthcare workers, et cetera. They're living miles away, adding to transportation costs, commute times, et cetera. And that's creating the big problem. And I think it helps to think about it that way, really the rent we're talking about is as low as 1,200 a month. And at an 80% AMI level, there's no federal programs to help that. And that prices people out of most US markets.
Right. So Tom, can you, for the folks listening, can you define what an AMI is and why that's important?
Well, that's the average, that's the average median income in the service area, right? So the way that housing works in the US is the federal government has government-derived statistics that looks at wealth levels and income levels in areas, and then they channel their subsidies, their voucher, their tax credits based on those income levels. And so one market, the median AMI may be $50,000. Another market, it may be 70,000. That all defines how much money goes to certain areas, et cetera, and defines what you can charge for rents in those areas. But many times in those areas, the rents that are actually found, the market rents are much higher than what the folks at those levels can afford.
Right. And, so look, I'm a big believer in tokenization, right? So tokenization from the dirt all the way to the debt structure, all the way to the funding, to the funds and the distribution of the asset. But importantly, I mean, do we think that the existing regulations in place, and this is an open question both for Steve and Tom, I mean, from a development standpoint as well as from a regulation standpoint, are they a hindrance today? Like, what do you think needs to change really so that anybody listening in, anybody that's on Solana, that holds stable coin or perhaps owns Solana, can come and invest? Because that fundamentally starts to create an ecosystem where the housing can be unlocked. I mean, or am I totally missing the middle mile over here and already in the utopian world? What do you guys think?
No, look, I'll start that answer and we'll see if Steve and I agree. I think we probably do. But I think, first of all, you're talking about supply demand imbalances, both in the capital markets and in the real estate market, right? So we have lack of supply of affordable housing in the US. We see this all the time. And where it's really acute is in this this middle market, this essential housing space we're talking about. We also have supply demand imbalance in terms of capital sources to fund it. Okay. And if we can bring more capital, more supply of money to the marketplace, we can fix this market. That's exactly what the federal government does on the low end. It's not needed on the high end, and we're trying to create it in the middle.
That's correct. And so let me add just a little bit. I think what's really interesting and timely, and hopefully everybody has seen this, there is some new demographic information on home ownership that came out this week. And the startling number is that the average age or median age, I'm not sure which one it is, of first-time home buyers in this country is now 40 years old. So that means that if you take that as that's that when we were younger, bought my first when I was I was 28 or so. I mean, that's all skewed up 12 years. So we were homeowners. Now anybody in that age group is going to be a renter. So our focus is on trying to help that market. As Tom said, there's such an imbalance between supply and demand in all sectors, whether it's rental or for sale. The current discussion about going to 50-year mortgages will not do anything materially to increase the supply of housing. The demand is going to be there and getting greater. So what we focus on is how do we accomplish that crunch on the income level of working folks, and not have to go to the luxury apartments, which are the domain of large public companies, or the more affordable, which is the domain of low-income housing tax credits and other things like that. And the way to do that is to expand the capital that's available to finance these projects. And when I say that, this is almost a universal known that generally the default rates on workforce and affordable housing, much more history in affordable, is much less, the default rate, loan default rates, less than in luxury apartments because people need places to live. And for the most part, they will do whatever it takes to stay where they are. So what we're to conclude in what Tom said is we've got to figure out how to increase the supply of capital for that middle market, that missing middle. And the way to do that is to take it and segmentize it, so that we're not providing 100% of the financing, but we're providing sort of the tail end of the financing to make deals work. And we do that on a risk-adjusted basis, thoroughly underwrite projects, both brand new and rehabs, and preserve existing housing. And it's truly a win-win.
Right.
And just Manish, just one quick point to strengthen what the comments that Steve just made. If
Right.
you look at the market sectors in housing and multifamily housing, the luxury housing sector has an average occupancy of 87, 88%. So there's a lot of room to add more people to those buildings. If the average is 88%, that means some buildings are 80 or below. So probably not hitting their break even and at risk of defaulting. In the affordable housing segment, the occupancies are 96, 98%. They're completely full buildings. There's such demand for housing, people don't leave them, and that's why it's a good sector to invest in.
Yeah, no, amazing. So Jim, I mean, like, as you think about tokenization of real estate structures, how does it really help? I mean, how are we thinking about this? What are you thinking about in terms of as you work with Tom and Steve and everybody else? What's the general sense in the market from a tokenization standpoint, which potentially could lead to the capital formation that we are all hoping that it does, because there is tremendous capital on chain. How does it funnel in?
Yeah, thanks, Manish. That's a great question. First of all, I think this is a very timely and exciting topic. We've all heard the stories of teachers driving 2 hours to their jobs and police and firemen living, 3 counties away, all that stuff. So I think this is a very important topic. And as it relates to tokenization, um, we we believe that this capital gap that Steve and Tom have been touching on can be filled through on-chain capital. I think there's a lot of opportunity to bring tokenized securities on chain where people may not want the volatility of cryptos and meme coins and et cetera, but they want some of the benefits of being able to deploy their stable coins into some real earning assets on chain. And so this partnership with Steve and Tom, I think, is a great opportunity to take that first step, to provide an opportunity for on-chain investors to have a real solid vehicle to invest in, earn some income, earn some return, in whatever structure we end up with, and expand that capital pool to fill that capital gap.
Yeah. So Tom, I mean, there is clearly a component of KYC AML that is not very much liked on chain, but then tokenization does have its benefits, right? It can certainly streamline the onboarding process. It can streamline the transparency, and the process kind of goes towards building the capital allocation. How do you see that, Tom? Given your experience in the fixed income space, where do you see this going? Tom, you may be on mute while you're talking, and everybody.
Sorry about that, Manish. First of all, I think that the importance here is partnerships, right? And so, on the phone here, you have a capital markets broker dealer, bond structuring firm. You have a stable coin blockchain expert firm, and you have a real estate expert firm. And so we bring together these different disciplines to do this correctly, right? And so one of the great aspects of this is we're going to rely on the experts in certain areas of the transaction to make sure it works. I think, there are also oft discussed implications of going blockchain native with these investments, right? And it's increased efficiency, it's enhanced liquidity, it's improved interoperability, reduced costs, increased transparency, as you talk about with the KYC, especially. But we will look to you for that in these ventures. But I think what's really important for what we're trying to do here is the new use cases, right? So we're trying to fill a capital gap. We have a growing marketplace of stablecoin that is starting to invest in money market funds and other capital markets areas. We have a universe out there that we think is socially conscious and cares about where their money goes and how it's being used. And what the blockchain and working with you is really allowing us to do is come out to a marketplace that maybe hasn't thought about the essentiality of this housing and how important this is, and hasn't thought about the great risk return profile that's there, that we can now bring that capital into this market. And so
Yeah,
the new use case is the biggest advantage I see.
right. I mean, look, I mean, I'm looking at RWAXYZ right now, real time, and it's telling me there's $13 billion worth of stablecoin in circulation on Solana, right? Which is a tremendous amount of capital unlock that you could potentially see coming towards the real estate and housing infrastructure. I think, to me, if we can create a vehicle that allows investors to come in at a minimum dollar amount to create a structure that then allows the missing middle folks that want to own a home fund their housing infrastructure. I think that, to me, is really the critical component and value of blockchain and the value of capital creation of blockchain. I mean, that's the exciting part, right? I mean, the hard part is what we are doing behind the scenes, which is identifying the location, with work that we're doing with Littlestone Company, putting the structure together that you guys are really doing, and then finally unlocking that structure on Solana, which I think is the right platform to be building this whole capital stack. So as we think about this one, do you foresee, Tom and Steve, that the housing infrastructure that's going to get built in the US, that we're calling it the essential housing infrastructure, that can be funded by folks across the globe, or does it have to be investors that are coming out of the US only?
Well, I'll take a shot at that first. I think we see a large amount of unmet demand worldwide for investments in U.S. infrastructure and real estate, and we've been talking to firms overseas about their interest here. And we believe that tokenizing ownership can efficiently tap into this demand to the benefit of project developers and investors. The blockchain allows us to reach investors anywhere in the world. It allows us to untap this money through working with you, and allows us to bring goods to the marketplace. And so I do see global investor demand, although we're funding in the U.S. municipal bond market. The nature of the investments that we would tokenize will be the municipal bonds, but will also be higher yielding securities that will have attractiveness to investors that do not need to rely on a U.S. tax status. So we can tap international demand.
Amazing. Steve, your thoughts?
No, I agree with what Tom said. We've seen in the past an up and down flow of, foreign investment in U.S. real estate. Many times the investment comes in the form of investments in operating companies. And then oftentimes it'll come in either through operating companies to specific projects or in specific projects. Those are generally of large scale. So the opportunity on the tokenization is for smaller investors to come in and participate in real estate, which they haven't had the opportunity to do unless, for example, they invested in real estate investment trusts. And then again, you're talking about a bit of a different animal than we're talking about. So yeah, we're excited about the prospect on this, that I believe that $13 billion is going to grow dramatically. We're starting to see already movement in it. We're the development part of the team. We have a great partner here with Celadon and Alphaledger. So we're excited about the prospects.
So Steve, I mean, you obviously have decades of experience in this business. I mean, how are you seeing the evolution of this digital ecosystem impacting your business? I mean, do you see a value in that? How this sort of morphs into a deeper integration with the crypto landscape?
Well, I think yes. I think frankly, it's just now really starting. Real estate's interesting. It takes somebody to make the first move, and then all of a sudden you'll see the second and the third, and then all of a sudden it's a tidal wave. We're just now starting to see crypto being the concept of crypto and all the implications of crypto being looked at in the real estate world. I saw a listing the other day, a fund that advertises on the radio and on XF on cable, and they're talking about in a very broad way crypto, but you got to go to their site, and then they're still kind of vague. But we're starting to see that now. I think it's going to be a great additional source of capital. The capital markets that we've traditionally looked at are bonds, municipal bonds, and banks, and U.S. government guaranteed mortgages. And those are typically flow through Ginnie Maes, so it's a form of bond.
Right.
We haven't seen really anything in the crypto world because it's relatively new, but we're excited about it happening. We're most excited about being on the leading edge of it. So yeah, I think the implications will be dramatic. One of my concerns always is in the real estate world, it's just a huge herd mentality, and there have been financing models in the past that when they work, all of a sudden it goes from 0 to 100, and everybody's doing it, and then the feds come in and close it down. So, I mean, my hope is that there'll be restraint, which I think there will be, and there are good people in it, which I think there will be. And so the answer is all positive as far as we're concerned.
Yeah. So Tom, I mean, if you could snap your finger, and I know we have talked about radio and cable, and I don't know how many people on the X spaces listen to radio and cables anymore, but if they do, and hopefully they're listening, what's the one request that we think we need to make for the regulators? That is the MSRB, perhaps FINRA, maybe the SEC, that allows for the capital formation to sort of take place purely on chain. And nobody's talking about sort of not being compliant. I think that one of the things that we're trying to figure out collectively is what should the regulators really do? How should MSRB look at this asset class? Because it's an important asset class that people should be investing in.
It's interesting, Manish, because I look at this as the process of investing stays the same. The how we go about it changes. Some of the intermediaries change, but but we're creating municipal bonds. We're going to have to live within the framework of MSRB rules, FINRA rules. We are a broker dealer, so if we are selling the security that we want to sell, that we have to follow all the SEC and FINRA rules, et cetera. So that's not going to change. I think the marketplace for this investment hasn't grown mostly because of a lack of risk capital that is fairly secure, has good return characteristics, but doesn't have enough capital to deploy. And so I think that's the biggest thing. Steve and I have talked about this for months. Really, it's no different if we sell a fund or we sell a real estate asset, tokenize it and raise money on the blockchain. To him as the developer, it's no different. It goes right into the trustee. The money flows to the trustee through the exchange mechanisms, and the project is financed and moves forward. So we have to. I think we're going to have to follow all those rules, and I'm sure there's going to be a lot of regulatory eyes on it. But we, as a regulated entity, are going to follow every rule we need to follow. And I see we have one of our counsel on the phone, and he's going to make sure we do the right job when we're putting these transactions together. So
That's good. That's good. I mean, look, Jim, you were in the banking world before. I mean, how do you see this playing out with the banks? I mean, clearly, look, I mean, the Fed's talked about it. that blockchain firms can come and request for an narrow banking license. We'll see how that really plays out. But is this an opportunity for the banks? Is it an opportunity for the clients of the banks? How do you see that playing out in your opinion?
Yeah, absolutely. I think what we're kind of outlining here today is just the first step, right? Of bringing new sources of capital in to fill a capital gap to get these projects going. Is the start, but where this can really go, especially when you put it in the context of the Genius Act and various other legislation underway, is that I can see in the future where the whole settlement and payment rails for real estate is on chain. You pay your rent with stablecoin that goes straight through to all the investors that are in the project, and it's just a seamless, very efficient system. So that's what. And then on the other side of that, for the investors, it's eventually going to unlock secondary markets and liquidity through DeFi protocols and all these other wonderful things that you can do on chain that are a little bit harder to do uh, in traditional finance right now. So I think it's a huge opportunity for the entire ecosystem of real estate, which goes beyond just the developers and the underwriters. It's the banks, it's all the intermediaries, it's everybody that can be involved in that.
Amazing. Look, I mean, I think collectively, I'm very optimistic as to where the ecosystem is sort of headed. We clearly need more projects like these. I mean, so we have announced the $1 billion pipeline. Now the real work starts, which is unlocking the pipeline, unlocking the capital stacks. And my hope is that this partnership really does become the leading case study in how and what to do as we unlock the housing infrastructure. And perhaps the entirety of the capital stack is raised on blockchain. I mean, that remains to be seen, but that's really my hope. So with that, I know we're on time. I certainly appreciate Tom, Steve, Jim coming on. Any last words that you guys have for the audience? And we'll close it after that.
Well, I have my summary pitch for you. So it's our as we've all talked, our vision is to bring a safe, stable, high yielding investment opportunity that is socially conscious to a growing market. That is, for the most part, I believe, underinvested in real world assets and overinvested in safe money market funds. Traditional portfolio theory would suggest that investments should be diversified, investors should be in diversified types of investments. Our target is a slice of the funds that are now moving to money market funds in the stablecoin universe. In this methodology, one could invest in a single housing project, or they could invest through a fund. And an essential housing fund would have the following attributes: it would be a diversified portfolio, it'd be professionally managed, stable cash flows, typically safe investment sector of multifamily housing, with a focus on the essential submarket, and high returns, similar to what you folks are working on with your T12 fund. And so I think there's several different ways to play it. We haven't defined the vehicle yet. Like I say, it could be single housing projects, could be a fund. People may prefer to pick the project they want to be in, or they may pick professionally managed. But I think that there's a great opportunity out here. It's a socially conscious investment. It's a needed marketplace, and the capital is relatively a strong investment with good risk return characteristics. So that's the opportunity set in the essential housing space as we see it.
Yeah, and
Amazing.
I'll just add on to what a little bit to what Tom said, working backwards from his last comments. Um, the demand for a product such as we focus on is so strong. I can't even use enough adjectives to describe it, and it will only get stronger as the cost of housing keeps going up. I don't really see how there can be a major adjustment in costs, so the only way to satisfy this demand is to create some vehicle that will allow us to address it. And maybe the way to do that is exactly what Tom's talking about, and that is to segmentize the capital stacks. And that's the plan of the fund. And, just as quick as we can get this fund going, we can deploy capital in very much needed assets, socially very much in demand, and practically in demand. So I want to thank you for the opportunity of addressing this, and hopefully we'll get to do this some more.
Absolutely. Thank you all for coming on, and looking forward to an updated podcast, or X Spaces, I should say, soon about the housing infrastructure.
Great.
Right. Thanks,
Great.
everybody.
Thank you. Bye-bye.
Thanks, everybody.
Bye-bye.